So we've hit the noon hour now, and as promised, we're going to bring in Tech Trader. Good morning, Sean. How are you?
Good morning. How are you doing?
I'm doing all right. I know you've got a lot of things on your mind to talk about, so I think we'll just start with the LITE. Since it's the most recent, then we can kind of backtrack into some of the other things like Finisar and IIVI and whatnot. But let's talk about LITE and its significance in Apple. Are you able to hear me okay, Sean?
It's kind of cutting in and out. Let me try something quick, okay?
Okay.
I'm going to call you right back.
Okay. All right, so bear with us. We'll try this one again. All right, we're going to try this one more time, bringing in Tech Trader. How are you, sir?
No, my apologies. I had a Bluetooth snafu.
Oh, all right. Well, short Bluetooth.
Yeah, well, I mean, it was set up, but I don't know. Sometimes it just doesn't take. So
yeah, I could see there was some type of connection problem on our thing here, and I was hoping it wasn't us because that would be bigger problems. But since you were able to fix it, let's roll. All right, so I'm not sure if you heard my question. I was talking about LITE and its implications for Apple because, let's face it, Apple's a big component. People are watching it. People are trading it. It's down 4%, and that seems to be what the overall takeaway is from a market perspective. That's what we're hearing on feedback. Well, what's your overall takeaway?
Well, I mean, first of all, anybody that's been reading my stuff for weeks or months really shouldn't be surprised that Apple's down. I haven't been short Apple. Although I did short it once or twice this year, but I haven't been short it recently. But I've definitely said that there's just so many other things to be long or buy, and then I've also said that there's an Apple paradox. I think I even use those terms. And for people who haven't read everything, although it's been out there plenty of times, it's been very strange how Apple's traded on what, in my view, they haven't had a great report for quite a while. And I would really say, I mean, before the last report where they actually missed guidance, they've been muted to soft to tepid to maybe whatever kind of term you want to put on it. They really haven't had a great report for quite some time, especially relative to the stock performance. So it's kind of been one of these things that said, again, well, there's even a FANG that includes Apple. The original FANG does not include Apple. I actually don't think Apple is a FANG stock because Apple is not an overvalued growth stock, which all the FANG contingent stocks are. Apple is a very cheap value stock. But the problem is Apple has traded, I would basically say kind of anything that's sort of since the stock hit about 160, 165. I would almost say it's kind of undeserved. It's because, and it's not because you can't say that Apple hasn't deserved it on past performance, but I mean, there were tons of quarters, whether you want to go back to 2013 or 14 or 15 or 16, where Apple had much better reports and the stock was flat to down. And so it's kind of this whole macro trade that we sort of entered sort of mid to late 2016 that continued for 2.5 years, where just a certain small number of stocks are basically anointed and likely algorithmic programmed to kind of go up, and then everything else kind of went down. And so again, for whatever reason it is, Apple kind of got a free lunch for at least 2 quarters, if not 3. So again, I would almost kind of say anything kind of plus 165, 170-ish It wasn't really backed by anything that was in an incremental improvement. It was just that people justified that the stock can trade at a slightly higher valuation than it has for quite a while. And so as far as Light, I'll get to Light in a second, but just wrapping up on Apple, and Apple never became an expensive stock, but it got pretty expensive relative to itself. So for example, when I was buying Apple in 2013, made it my largest position, they literally were trading 4 times net cash. If you backed out cash, I think they were trading at something like a PE of like 7 or 8 net of cash. So Apple's not nearly that cheap. I mean, it's basically trading at double the valuation, maybe even triple the valuation it was back then. So, Apple got expensive relative to itself. And then the other thing I've been talking about with this Apple paradox is that you had an almost decimation in the price performance of pretty much all the Apple suppliers. Again, this has been relative to Apple over the last year. So, what's happened to Skyworks, what's happened to Avago, what's happened to Qorvo, what's happened to CRUS, Cirrus Logic, etc. Now, Light had hung on pretty well. But if you basically, Light was the only Apple supplier that had sort of traded okay this year. I mean, all the other Apple suppliers traded terribly. And again, that just doesn't make any sense. Because if Apple's doing well and Apple's knocking out all-time highs, shouldn't some of the suppliers be at all-time highs? And they weren't. So one of two things had to happen. Either a ton of Apple suppliers had to make up for a ton of performance and go up like 50 to 100%, which I didn't think that was going to happen, because the only Apple supplier I said I liked besides Light, and I haven't liked Light much. I haven't been long it. My last trade was like an 8-point trade or something. But the only Apple suppliers I kind of like are Cirrus and Skyworks. Yet I haven't liked them enough to personally go long the stocks. So anyway, you'll wrap all this up. Okay, what happened to Light? I think something very simple happened to Light. Apple just said, "Oh, great, IIVI 26 bought or is going to merge with Finisar. That makes us more comfortable with Finisar, the fact that we put $500 million to $600 million into them. We were already going to, again, I'm paraphrasing like, Apple leadership. We were already going to shift a lot of market share from Light to Finisar because of this investment, because of this 3D sensing fabrication facility we invested in. And now we feel even more comfortable shifting that market share because now we obviously, I guess Apple likes 2.6 and Finisar combo more than they like Finisar themselves. And in fact, I would almost say the combo of the merger plus the Light guidance plus how Apple's trading, it's almost instant confirmation that this totally explains the skinny premium on the Finisar deal. So in fact, Finisar may have been, again, I can't prove any of this, Finisar may have been somewhat strong-armed to merge with 2.6. And I think it kind of all becomes clear now. They probably were strong-armed to merge with 2.6. It was probably driven to a certain degree by Apple. Apple probably wanted, 2.6's management with combination of Apple's fabrication capability, on and on and on. But anyway, this is. Let me put it this way: we just saw 2.6's guidance. We're going to see Finisar's guidance in 2-3 weeks. We just saw Apple's guidance. That Apple didn't guide down by 20%. 2.6 guided up. So anybody that's saying that this is, Apple has broad weakness and the iPhones are selling bad and they're cutting iPhone production by 20 or 25%, i.e. the amount of the guide of the Finisar guide down, they just don't. I mean, anybody that's saying that doesn't know what they're talking about. I mean, this was very well telegraphed that market share shift or Apple's share of 3D sensing was going to move to Finisar. It was a matter of when, not if, and I wrote that in a note today. So now the question is it all market share shift? Probably not. I mean, Apple did guide lower, so maybe they have some unit production that's not quite as good as they planned. But I mean, it's like 80. My guess is it's 80-20. I bet when we finally see the math on it, if we ever do, it's probably 80% shift, 20% slightly lower sales. So, but again, doesn't mean Apple's like done going down here. But anyway, I think we see this all the time too. 2.6 literally stole Finisar. So what has the stock done? It's gone from 48 to 32 in basically 2 days. I don't know. I mean, I 2.6 is like all of a sudden one of my favorite stocks. So we'll see what happens. But I think that, I mean, the buying of Finisar at the price they bought it, probably added 20 or 25 points to 2.6 ultimate valuation. And then we see this all the time. Stocks a lot of times in the short term literally do the exact opposite thing that they should do. By the way, I did buy more 2.6 literally about 4 minutes before we got on the phone today. I got it pretty close to 32. I didn't post it because, one, I was trying to get my Bluetooth going. Two, I don't know. I tend to only post trades I'm going to keep that are more investment-like. I don't know how long I'm going to keep this. I mean, this stock pops $3 or $2 in an hour. I'll take the trade. But I'll just buy it. I'll start trading more 2.6 more frequently. But I would say this lines up as almost an extraordinary opportunity. I think Finisar at sort of anything at 21 or lower, you can play the arb trade on that because they probably will trade pretty close to 26 upon deal completion. 2.6 guided higher. I mean, there was. I don't know if the stock should have gone from 35 to 48 in what took a week or two, but hey, I mean, I think they should have gone up. They had they had one of the best earnings reports of the quarter. So, I mean, we'll see what happens. I doubt we'll see a guide down from Finisar. I mean, if there was a guide down, I mean, 2.6 just reported like a week and a half ago. So I doubt there's been a material change in iPhone sales in the last 3 days. Because if anything, iPhone sales and their sort of the what do you want to call it? The trajectory of sales, the consistency of iPhone sales is actually very sort of even keel now. I mean, it's a very old product. Upgrade cycle's pretty slow now. There's not like the people aren't waiting in lines for new iPhones. So the trajectory of iPhone upgrades is pretty plodding. So, I doubt there's really much going on there. Again, I think you got a tiny little bit of weakness from Apple and mostly a market share shift. So there's my whole story. I'm almost 100% sure I'll be proven out on this. And again, I took a little bit of advantage. There's a lot of other stuff trading pretty cheaply too. We could talk about though that, maybe the market needs to retest. We never had a sentiment retest, but I'll stop my diatribe here.
All right, so my first inclination after breaking down the Finisar deal just by myself was, I wonder if TECHT is unhappy with this one, because I wonder if you were disappointed based on the, I guess, lack of premium, where it was trading. Usually you don't see these deals when they're trading towards their lows, and I know you're looking for much bigger percent moves than 30%, even 50%. So my first inclination was, I wonder if he's disappointed on this one.
I hated the deal.
Right.
Hate the deal. I mean, it's in fact, it was one of the worst deals historically. In fact, this was before a huge personal, almost a life-changing move for me personally. I had a stock called Acme Packet, and I had a pretty big. But this is late 2012, early 2013. I mean, I had just pegged this thing out. I modeled it. I'm like, I'm gonna make 2 to 3x my money on this. And what happens? Oracle buys them for a very skinny premium. It wasn't nearly as bad as Finisar's premium, but it was so like back then. Let's say a stock would get taken out 65, 85, 100% premium, and this was like kind of a software type name too. Uh-huh. They sold for like a 25, 30% premium, and what it was, it's kind of a different thing, but what it was the from 2011, the European debt crisis, to 2012, when really only Apple and Netflix went up before they caved, to early 2013, everybody, and I remember 2013, I went into that year being like almost crazily bullish. In the most of the world, that was back in the days where most of the analysts were like, we're probably going to have a negative year now. 2013 is probably going to be a negative year. Well, what that particular deal was almost like the bottom tick for M&A. I mean, literally since then, I hadn't seen a deal as skinny pretty much since Finisar. I mean, that was like literally the worst amount of premium I saw a company get taken out for in years and years and years, and before and since that, by the way. And so then what happened after that? I bought Facebook cheap. I bought Apple cheap. Facebook went 3x. Apple went 2 to 3x. All my kind of my frustrating positions from 2011, 2012 ended up being huge movers. Micron went from 6 to 30, so it went 5-bagger. I don't know, kind of could be a similar type signal, but I think for Finisar, again, I think they were strong armed. I think Finisar has always been sort of this lumpy reporter. I mean, they're a high quality company and they've been very good, but maybe they weren't the greatest company from a delivery company, a company that delivered products to their customers. Maybe other companies out there did a better job and do a better job than they do historically. I'm not a supply chain expert. I don't follow every single product that companies make. But anyway, I kind of do. I kind of think they were almost strong-armed into agreeing with this deal, with this real skinny premium deal with Light. I mean, hey, it wasn't that long ago. Finisar was trading sort of 32 to 35-ish on their own. And they're not an expensive stock at $35. So, something was going on behind the scenes. I don't know if they wanted 2 6s, sort of laser slash 3D sensing expertise to kind of help them. But again, I kind of think that there's no way Finisar sells unless they were basically pressured into selling. Now, by the way, the deal's not done. I mean, somebody else could come along. The shareholder base, shareholders have to approve the deal. So we'll see what happens. I mean, it's a terrible deal, though. Yeah, no, I wasn't just kind of disappointed. I was outright mad that Finisar basically agreed to such a skinny deal. But for me, I can replace it. I can basically just replace my Finisar position with IIVI, because ultimately what will happen is all the benefits and growth that would have come to Finisar from the combination of 3D sensing and fiber optics will now just end up coming into IIVI. And you know me, I'm not one to really worry about, hey, if I don't get paid today, that doesn't mean I'm not going to get paid tomorrow. So I'm not one that believes in I got to try to make a certain amount of money every day trading, and if I don't hit that means I'm never going to make that money. I sort of more believe that, a really, really good trader might make 2 years of returns in a 6 or 8 week period of time. And so even the greatest prop traders I know, a lot of times they'll make the bulk of their monthly P&L in 2 or 3 good days, right? So the bottom line is money comes in the stock market. When it comes, it tends to come in bursts. And hey, if I can own all the assets of Finisar under a different ticker, I will. And so the weakness in IIVI is kind of giving me a chance to sort of slowly build or slowly build a position in IIVI, a name that otherwise probably wouldn't have bought them, or I wouldn't have bought them at current prices, or current prices being the 45 to 50 area. But hey, the market wants to take 10 points out of them. I'll buy a little, then they want to take another 4 or 5. I'll buy a little more. In fact, I think I said on my plan, my plan was to buy more at 35. It's just dropping so fast, I just kind of held off. I'm like, okay, if I can buy it close to 32, that's $3 better than 35. So I'll do that, and I'll kind of build this position. And by the way, I'm not in a hurry. I think I'm going to get something close to 26 out of Finisar. So I'm not going to sell Finisar at 21 when I kind of believe something will happen and at least get me 25, 26 out of it. I mean, at this point, too, I almost not so sure that, if some good things happen and the deal gets broken up, it doesn't trade higher anyway. So anyway, we'll see what happens. But I'm just not worried about this fiber optic space. I'm not worried about the 3D sensing space. There's still really good growth in 3D sensing. And I think over time we will find out that Light lost a lot more share than Apple is losing iPhone sales.
All right. Well, how do you recommend that traders would go about executing something in Finisar and IIVI? And I understand some of the confusion. We do actually have a feedback question. Would you sell Finisar and put the proceeds into IIVI? And I thought that's what you were trying to convey.
I would at probably $24.50. But
not at 21.
No, I mean, if Finisar was 24.50 and IIVI was here, by the way, I doubt that would happen, by the way. If Finisar is back at 24.50, IIVI is probably 42, right? Or 44. But let's just assume if Finisar was 24.50 and IIVI was 32, yeah, I'd sell 100% of it right now. I would sell 100% of Finisar right now and move. Well, I don't know if I'd move all that money, but I'd move most of that. I'd probably move 80% of that money right now into IIVI at 32.70. I just swap funds. The problem is Finisar is, again, they're gonna get bought for basically $26. And people say, well, wait, if IIVI can't get, well, it's $15 in cash. So it's I don't know if it's 2/3, 1/3, or if it's 3/4, whatever. But the bulk of Finisar's buyout is going to be in cash. It doesn't take that much value. In other words, Finisar's dropped in price way more than IIVI share price has dropped. I mean, it's probably trading at something like a 25% discount. Like, you could just, if you're an ARB guy, you're probably looking at Finisar right now going, geez, there's like $3 of value in it, right? Just on deal terms, there's probably $3 of value. So that gets you to 24, and then if IIVI just goes back to 42 or plus, okay, there's 26. So, I mean, right now you can almost kind of take a stab at either. Part of the reason, by the way, that I haven't sold any Finisar is because I almost view it as crash protection. And then I think I even told you, I wasn't so sure this market was done going down. We never got a sentiment retest, even though we got a price retest short term that was actually incredibly bullish. But okay, what happened? What did everybody buy? They bought the same old stupid stocks. Amazon went up 250 points. A bunch of the FANG names bounced. Apple didn't really go down very much from a pretty bad quarter. So anyway, the same names bounced again, especially Amazon. People bought in the same stuff. There was 5 days where people could have bought great prices in the market, but what did you see? All the volume came in 2 days ago. So everybody waited for the market to bounce huge, a bunch of stocks to bounce huge, and then you saw a bunch of buying come in the last literally the last 2 days of the market pop was the most buying. And so it's not a big surprise that we're getting this big algo raid today on basically no news aside from the light downgrade. But the bottom line is, if we have a sentiment retest, there's an inverse head and shoulders pattern on the S&P. I still think there's plenty of room. I mean, again, Amazon's not cheap at 1,700. Netflix isn't cheap at whatever it's trading at right now. Yeah, Nvidia's gone down 100 points, but what if they should be selling at 100 instead of 200? So there's all these names out there that I still think have an incredible amount of fluff in their prices. So now something like a Qualcomm has immense value. I think most of the fiber optic space has immense value, but the main reason I've kept Finisar is this is basically crash protection. I mean, it's like, look, I mean, I have something I pretty much know I'm going to get paid off, and let's say worst case scenario, I get 23.50, 24 out of it. Best case, I get 26 or more. I don't think there's much. I think that's a hell of a hedge versus a market that I don't know what the market's going to do between now and the end of Q1 next year. So I almost think IIVI is getting close to kind of crash protection prices. I mean, it's trading now, I think, 3-4 points below where it was before they reported a very clean and strong beat and raise quarter. I mean, that's just weird. So again, stuff's weird. But no, if Finisar goes up enough and IIVA stays down enough, it's a beautiful swap trade. But selling something for 26 when you get a buyout, or selling something for 21 when you get a buyout price for 26 doesn't make much sense. That's a lot of embedded return with pretty low risk, I think.
So would you still be buying Finisar if you didn't already have a position?
I would. In fact, I almost bought Finisar today. The difference is I actually think, I think IIVI could pop a lot more than Finisar can pop now, short term. By the way, I even thought that at 38. I mean, at 38, I think IIVI can pop more than Finisar. Again, we didn't know light was going to guide down. That was a shockingly bad guide down. In fact, you would almost kind of think that Apple would kind of work with them and kind of allow them to kind of have a 2-quarter kind of guide down or a 2-quarter period to kind of take the hit. But it's almost kind of like they just sort of said, oh, sorry, we're shifting, a huge number, tens of millions of units away from you to IIVI Finisar now. And again, by the way, people can debate me, but the math is clear. Again, IIVI didn't guide down. We're going to see Finisar's report. I almost guarantee you they're not going to have a guide down. Apple didn't guide. What is Apple? Pretty much, the vast bulk of their revenues are iPhone. They didn't guide the revenues down 15-20%. So there you go. I mean, the only explanation is this huge market share shift. And again, shouldn't be a surprise. It's part of the reason I've not had Light as an investment vehicle is because I kind of knew that at some point they were going to take this big market share hit, this one-time market share hit in 3D sensing. Because if people haven't forgotten, Apple didn't put $500 million in the Light. They put $500 million in the Finisar. So again, the frustrating thing or the crazy thing is that, again, Finisar agreed to the deal price they did, and maybe they didn't have a choice. Time. We'll find out all this in time. It's almost kind of a beautiful situation that you can basically instead of having one stock that kind of is a for sure winner, again, you're basically being able to buy a 2.6 at this huge discount. Again, just embed all of Finisar's revenues. I mean, I don't even know what multiple. Let me just look. I think the deal price they paid. Now again, I'm using my numbers and knowing the growth rate of what Finisar's 3D sensing business alone is going to grow to. I don't even think they paid two times sales for Finisar. I mean, that's hell of a good deal. So my experience is anytime companies, why did Avago get so big and why did Avago's share price go up so much? Is because they were able to do quite a few deals like this. They bought quite a few competitors and quite a few small chip companies out for really, really attractive prices. And people forget. I don't know if people know the history of Avago. It was a spinoff of Hewlett Packard at one point. But in 2013, Avago was $32 stock. I used to trade Avago. And in fact, I owned Avago for periods of time and made some pretty good gains on it. But yeah, $32 stock in 2013 that basically went 10-bagger, mostly on smart M&A. So, unfortunately right now, in a risk, this is the other thing, in a risk-off market, which we're definitely been in. We've been in risk-off market since for sure September 1st. And maybe as early back as the summer. Risk-off markets, M&A doesn't really get rewarded until after the fact. What I mean by that is, Cloudera Hortonworks is another example. So people are just getting shelved. They're getting shelved, they're getting stopped out, weak hands, they're selling stuff. People aren't hanging around for M&A deals to come through and then see the numbers and then go, oh, hey, that was a really good M&A deal. Look at how good the numbers are 4 quarters later. If the deal is attacked and the price drops a lot, people just bail. They just have no faith. They just bail. I don't bail. I get paid over time. So, but yeah, it's in a risk-off environment. M&A deals tend to have very wide arbitrage spreads, and so and that's what we've had. I mean, pretty much again, you get it. So risk-off really accelerated at the beginning of October. But again, I think it started more like somewhere between August and September 1st. You can pull up a chart of Facebook, for example, and just sort of look at kind of the one-time drop in it, then the slight recovery. But then I think it was since basically September 1st, Facebook has been down like 85-90% of the days. And that's a great example of risk-off. And I think that's kind of what we've been seeing. There's been a very strong risk-off pulse in the market. And, I don't know if it's done. I mean, we never know it's done until the end. I'd feel better if I got a sentiment retest. But we'll just have to see what happens. But we're getting some pretty good opportunities here. Again, Qualcomm. I mean, why is Qualcomm back at 54? Again, I mean, that's one of the funniest sell-offs today, by the way. So, did people forget that Qualcomm basically doesn't have any Apple business anymore, i.e. Apple's not paying them? Yeah, they're still technically an Apple supplier, and they're down 3% today, even though Apple's not paying them right now. So it's like, well, wait. So if you want to attack Apple suppliers, the one name that probably shouldn't go down is Qualcomm because Apple's not paying them currently, but yet everything goes down. So it is what it is, and this will all get rectified over time.
All right. So, adding to Qualcomm, do anything in that name?
I'm not yet because I can't remember if I posted this on briefing. I definitely had some chat commentary with other people about this. I don't know, just kind of feels like a lot of names are going to kind of retest prior lows. And so I don't think Qualcomm's going to go all the way back to 51, but kind of 53 to 55-ish is kind of where I thought a few days ago it was going to go, basically after they kind of guided lower. It's kind of right around 55, right, or 54, 55 right now. Again, I'm just kind of back in the mode where I don't have a huge sense. I don't have a huge hurry to kind of jump in there and really buy anything. I'd rather wait for some EMAs to get retaken. And honestly, I don't. I'm just in one of these particular periods for me where I just might not move positions around. The only really notable change I've made is that I've started buying IAVI, and I'm going to build that position up. But I kind of like how I'm positioned. So this might be one of these rare times that I trade less and sort of hold more. So, we'll see. I mean, hey, I thought I was making a good buy and buying some Cloudera kind of in the high 13s, low 14s recently. And, that's almost $2 lower. So it's like, well, okay, I'm not worried about that. But it kind of seems like anytime you kind of buy something, you think you're getting a good grab, and a week later it's, another 10% lower. Just wait. Just wait for the stuff kind of settles out. And that's kind of my mode right now. And here's the funny thing. We had a lot of good reports. But, that's the other thing you're seeing. Aside, good reports are being rewarded and trading okay for a while. That kind of all ended, I don't know, about 4 days ago. There's no particular catalyst, but it's almost like, almost to the moment that Amazon got to where it was 250 points above its low, they kind of just started selling everything off again. So my guess is we just kind of got to kind of retest some lows. If you look at the S&P, it's got a very interesting formation. An inverse head and shoulders pattern would fulfill at 2710 on the S&P 500. So what are we at right now? We're at 2742. So, you got 30 points until you got an inverse head and shoulders. A lot of times what you get on that pattern is one of the shoulders will be lower than the other shoulder. And then there might be a lot of belief that the market might have to kind of sniff out a retest of that 2600. I don't necessarily think we need to hit 2600. And the reason is because just the pure speed that we're seeing stocks decline already. So in other words, the individual stocks almost seem like they're declining faster now on less of an S&P decline than they declined as they went down before. So whether it's a Facebook, whether it's Light, whether it's IIVI, whether it's Acacia, whether it's AAOI, which again, kind of really no reason it should be down to today. AAOI doesn't do any 3D sensing, but yet it's high beta name. So high beta name, NASDAQ drops 150, 200 points, they kill high beta. So, but the speed at which a lot of these other stocks are dropping is actually much more severe than when the market went from 2,900 to 2,650. So that's usually a good sign. When the average stocks are dropping faster, you don't need as much of a decline. So, but I'd be pretty surprised if we don't go below 2,700. So that could happen tomorrow. Maybe it takes 2 days. Maybe we bounce and then have another couple down days. So that's kind of what I want to see. I want to see a retest. I want to see sentiment go a little lower. And then maybe I'll finally get more of a setup where I'll get more aggressive on the buy side. But by and large, I've kind of just been holding. I've been holding a lot of stuff I like, and then been holding a lot of cash buying power and reserve and kind of just waiting. And, sometimes that's not the worst position to be in. By the way, I will say this. This year is starting to look a ton like last year. And what I mean by that is once everybody thought, oh, there's going to be a big year-end flourish, there's a lot of performance chasing. That didn't happen at all last year. If anything, people were wimpy at the end of the year. And if there was any prevalent effect, it was tax loss selling the losing names. And then what did you have? You had this unbelievably spectacular January effect. And so January and February were super, super, super good months for beating up stocks from the prior year. I kind of think the same thing's going to happen. I mean, I basically made my year in the first 8 weeks of this year. and I'm kind of almost setting up for the same kind of trade. I mean, if they just, I mean, hey, if Hortonworks just stays here and keeps going down, and same thing with Cloudera, and same thing with IIVI and Finisar, I mean, those names become tax loss selling victims, and they're almost, you can never say it's 100% guaranteed, but my bet is if I get a list of 5 or 10 or 15 of those, like 85-90% of them will win in January, February. We'll get a huge sort of January effect trade where everything that was sold off pretty much just for tax loss purposes get bought. And we've kind of seen that now. This would be kind of year 3 that happened. But last year it was huge. Meaning, so we ended 2017 with a big whimper. There wasn't much of a performance chase at all. Then you had a massive January effect in 2018, and right now it's kind of looking like that same trade's gonna happen again, unless we have a big year-end flourish that comes out of nowhere.
So you just volunteered yourself to come up with a list of 5, 10, or 15 names of tax loss sellers that are going to benefit.
It's not that hard because I own 5 of them right now.
Yeah, so, I know, but they're gonna put you on the hook for it.
Yeah, but no, that's not. And like I say, there's been plenty of big winners this year. But there's there's just, again, I mean, a name like IIVI is almost instantly becoming a tax loss selling victim because it went from sort of trading and I don't know, it was pretty close to year highs, I think, at 46. It wasn't quite there, but now it's at year lows. I mean, it's just the things are strange. I mean, it's just amazing. Yeah, the speed at which things can occur now, but that's what people, we should be used to this. It's people that want to believe the persistence of trends, and people want to believe recency bias and things like that. If anything, those things just don't work anymore. And what's the beautiful thing, and the reason you can probably hear the excitement in my voice last 3-4 calls we've had, is we're getting rotation. I mean, FANG, the people that are buying FANG, the dip buyers are just getting hurt over and over and over again. But again, is FANG cheap enough? Is Amazon at $1,500 to $1,700 cheap enough? I don't think so. So here's the danger of this market. I mean, what if the stuff really overshoots the downside? NVIDIA going from 300 to 210 isn't an overshoot. An overshoot would be NVIDIA going back to 80. What would be an overshoot on Amazon? Well, a 20% decline isn't an overshoot. An overshoot might be 45% decline. So, I mean, I'm not saying it's going to happen, but sort of the pattern of the markets of recent years, stocks don't really trade where they're supposed to trade. They either trade way above or way below. They don't spend very much time sort of trading at fair value. So, I don't know. We'll see. I mean, but that's the danger. And that's why hey, maybe I'm sometimes I'm willing to kind of stick it out with a name that's already beaten up. It's like, well, I'd rather be in a name that's already taken some pain in, as opposed to trying to sell that and buy something with a quote unquote good chart that has yet to decline. Because the one thing that we have seen over and over too is a lot of times stocks get to a point they don't drop as much more or not much more. Whereas the stocks haven't taken the pain yet. That's pretty much been the last 3 months of this year. Is like everything that hasn't been beaten up and that should have is starting to take its turn at the whip. So, FANG withheld. They withheld. It was the Teflon trade. Well, it wasn't until it wasn't. NVIDIA, same deal. I kept saying, I've been saying for a year that stock's massively overvalued, yet people kept buying it. Well, all of a sudden, that thing dropped 100 points fast. And AMD, same thing. I mean, we go on and on with all the things I've avoided. The problem is there's nowhere to hide. If you're long, you're going to take pain when other stuff is going down. There's not really any longs you can hide in now. You can hide with cash and with hedging. That's about it. But you can make up a lot of money really quick. I mean, you get a good report out of something, and the stock goes from, I don't know, let's say, in Twitter's case, wasn't that long ago, it was 6-7 points lower. You make up 7 points. That's a lot of performance you can make up in 2-3 days on a good report. But it's a very interesting, I do think we're rotating. And I said this before, when you go into periods of big transitionary phases where leadership changes, the markets tend to be pretty hard on most people. Because what happens is the only way you transition is everything usually gets hit, and then the new winners emerge from lower prices, right? So it's not like, hey, the stocks that should be going up, they just magically suck all the market cap from the FANG names, so they don't go any lower. They start going up while other stuff starts going down. Unfortunately, that's not the way it is. By the way, it used to be more that way. When we had an uptick rule and things like specialists and things like that. But nowadays, kind of they have to beat everything up. Things get oversold, and then you get to see, okay, what's the stuff that bounces huge off of crazy low prices? And we've definitely seen better bounces off value tech, value-oriented names than the FANG bounces have been. At least that's what I've observed.
All right, let's shift gears just a little bit. I got a new question from our listeners asking if you're still holding ELF, ELF. You involved in that one?
I do have some. I haven't really. This is kind of one. Honestly, this I might. You can't win on them all. I would almost be surprised if I exit this trade as a winning position. I basically view ELF like I used to view Pi, so impinge. So I kind of at one point I sort of regretted ever buying Pi. At this point, I don't, because I've made money on Pi. But yeah, I kind of view ELF like that. I was you can't get them all right. I sort of messed up on their growth estimates. At the same time, I do think there's quite a bit of value. I don't think the name will trade down here for a long time. This could be, this could be a good January effect trade. And they actually had an improved quarter. And so, as crazy as it was at 10, they made up 20, 30% of value in a hurry. I'd probably have to get back to something like 17 to break even on this. I'd have to look exactly, and I've traded this a few times, so the cost basis that I show is not really my original cost basis. Suffice to say, it's sometimes I kind of just hold a position like this because I still like it. I still think it's worth more than it's trading at right now. At the same time, it's like a lot of other names. I always think, oh, hey, I'm going to buy this. Well, then what happens is other names get crazy, crazy cheap. So, put it this way, Light wasn't even on my radar. If Light at 30 would be extraordinarily good buy long term. Now that's 9 points lower. This morning it was like 35. Wasn't that far away from 30 pre-market. So the bottom line, just have to kind of see. For me, it's always a relative game. It's always, okay, what like I said, I kind of like AAOI a lot now. In fact, much more than I have in a long time, probably since early 2016. So would I rather buy Applied Opto over ELF? So would I rather pay $19.90 than ELF's, what is ELF trading at, $12.90? I think I would. So the problem for ELF isn't so much ELF in that I don't believe it can trade higher. It's how many other good buys that I have. Carbon Black is another name, by the way. We haven't talked about it. They had a really good quarter. Now they reported at a time when good reports were having a harder time going up. Literally 2 days later, good earnings reports started getting rewarded in the marketplace. Carbon Black reported in that cycle where good reports are still being sold. This lines up really cheap. And I haven't added this, but again, I would much rather buy Carbon Black than ELF. So that's the only issue with ELF. I do have some. I do think it'll trade higher than it trades here, but for me, it's always a matter of what else can I buy. The other stock I think is very surprising. I'm kind of warming up to it more all the time. I do have some is DBX, which is Dropbox. What were they trading post-report? Let me look. 27. They didn't trade at 27 very long. But if they can get back above, I would peg resistance at about 26.50 to 27. And then above that, I don't really have much resistance until sort of like, God, I don't want to quite say 34. I'm going to say like 32 to 34. But yeah, so something like a Dropbox, I think is almost very maligned given how well they're executing, how well they're reporting. And there's just lots of that right now. There's biotechs like that. There's plenty of other names that are really, really cheap. But yeah, I don't mind ELF. I don't dislike it. I do think it's worth. I think it's worth like 16 to 20. But yeah, I kind of put it in that Pi camp where I just didn't really do much. The one thing I didn't do on Pi is I didn't panic and sell it at lows and then monetize a big hit. I basically kind of thought, well, it's stupid at 12. I could have bought more at 12, but I was buying other things. But at least I kept it, and it's almost doubled. Well, it did double from 12 at one point. By the way, I think they've had 2 good quarters in a row. I mean, that's a stock. If we ever get full on risk on again, Pi could go up a lot because that's kind of a former cult favorite. But companies like Pi don't trade well until there's more liquidity in the market. And we definitely have kind of remained in this liquidity vortex. When liquidity comes back, a name like Pi can go up a lot. Maybe that's been plaguing ELF as well. So yeah, long-winded answer because I've filled in a lot of other names in there. But bottom line, I don't mind ELF at all. I just don't know if I'm going to add to it because it's too much of a target-rich environment. If a bunch of other names are 30, 40, 50, 100% higher, then ELF would look a lot more attractive to me.
Well, you would think in the midst, if we did have a Santa Claus rally, a company like ELF would be a good one, right?
It could. I mean,
That's
I
just
love
a
that
silly joke.
No, I love the joke. But here's the one thing. I will say this: if I was inclined, I mean, part of it too, names that are non-tech names or non-biotech names are they're always going to be names that I buy last because where my focus is, right? Here's the one thing I'll say about ELF. I actually think we're going to have a real strong Christmas. And I think I forecast one last year too. I think the setup for retail, the setup for Christmas. Remember when I liked the ANF, for example, and everybody hated it? And I did really well on that. I think I made 4 points off of 12. Well, the damn thing went up. Did it triple from 12? I can't remember where. But the bottom line, I made 40%, and I could have made 140% or something. Macy's was another name I liked. Dick's was another name I liked. Under Armour was another name I liked. All those names ended up working pretty well. I would say if all those names can work, then ELF could work. I think I probably like ELF better than all those. But if you just kind of think about the lineup for Christmas, the lineup for retail, the average person has more money, the average person feels better, unemployment's low. I would say the setup for sort of retail, brick and mortar retail, is maybe we might have one of the stronger Christmases than we've had for a while, and I would think. That's pretty incrementally positive for a name like ELF.
Well, just for the record, I was going to use ELF and bringing that up just as a segue into retail, but you kind of covered it, so good recovery for you.
Yeah, no, I mean, if some of the retail names were cheaper, I'd probably be talking about them more. But like, I have a hard time buying Under Armour at roughly 100% where I liked it before. I mean, I'm gonna look up ANF. So I liked where was that? ANF I know I liked around 12, if not lower. So ANF's actually come off a lot. Yeah, I mean, I went to 29. It's back at 19. I don't know. I mean, again, it's kind of in no man's land. I guess I'd rather buy Cloudera, Hortonworks, Redfin, things like that over ANF now. I will look for some retailers, but honestly, I don't know if I really need to find a lot. If I was going to buy a retail name, probably would be ELF, to be honest.
All right.
So, by the way, I'm going to give that reader a lot of questions because I don't know if I would have brought ELF up, and it might be really timely. That's actually a chart I like too. I talk about, like, people ask me all the time, hey, what's an example of a chart where like you get an early turn? Here's the problem. Here's the only issue. So the alpha's back above the 5 EMA, back above the 10 EMA, some other technical indicators are positive. All that occurred, though, on an earnings gap. So the best chart is when you don't have a gap, because the problem with the gap is it might not be as sustainable. So if you didn't have any gap and the stock had organically gone from 10 to 13, and it had done it in a multiple series of days where it kind of earned that price move, that chart would be a better chart. It doesn't mean it's a bad chart, but just means that whenever you have a gap there, the potential for just weird trading activity exists. The potential for retests and things like that are higher. But yeah, no, I mean that chart that is kind of one of my preferred setups. I mean, and by the way, buying ELF at 1280, is it that much worse than buying it at 1080? No, not if you believe it's got 4 points of upside. If you believe it's going to top out at 1350, then you don't want to buy it at 1280. But I would say names like ELF. I mean, this is a great example. What is ELF really worth? Okay, the price is truth guys would say, well, it's worth what it's trading for right now. Well, but if the price of truth actually was a valid sort of trading theory, then it would have never traded much below 29. So that's the problem with price is truth, guys, is that if price is truth really held, then stocks just wouldn't move much because all information would be known, all the guidance would be known, all the bad news and all the good news they're going to have for the next 2 or 3 years would be known. So stocks would be really bad to trade because they'd be super efficient. And when in fact stock prices are highly inefficient and they move far more than they probably should because the core businesses don't change nearly as much as stock prices change. So if you kind of look at that in a microcosm and say, has ELF's business really changed that much since it was a $25 or $30 stock? The answer is probably no. The growth has decelerated, and the growth estimates are lower now than they were before. But ELF's business probably isn't radically different than it was when the stock was trading at 28. So therefore, what's likely to happen? The stock price will probably regress closer to some mean price, which is probably closer to $20. So we'll see. I'll put it this way, dude. They're going to have sufficiently worse news for them to go a lot lower than they've already been.
All right, so I got 2 more questions for you. One is on SVMK. Do you follow this one, SVMK?
I do. I have a tiny long. I thought I disclosed it. I might not have. I think I bought some right around 1180 or 12 or something. I'd have to look back in the thing. I only bought one little tiny trade. I think I even called it a toe dip trade. So this is a timely question too, because I would say their closest competitor just got bought for $8 billion.
And that was
right?
part of the reason the listener wrote in, because they have earnings tomorrow, and the competitor was bought by SAP this weekend.
That's right. So, but they're not exactly the same companies. I don't. The reason I probably don't have a bigger. I mean, here's one thing I have said. We've talked about. I didn't like SurveyMonkey at the IPO price. I think what was it? First day of trading was like 19. I think I was the most I was willing to pay was something like 14.50 on the first day. It traded way above that. So my guess is the company SAP bought probably is a much stronger grower. I haven't looked at all the particulars of that deal. I know they paid 14 times out year sales. I think they paid something like 20 times current year sales for I don't know what. Help me out. What's the name? Qualtrics, something like that. Qualtrics. Okay, so I know that company a little bit. I mean, I looked at it because it was going to IPO. And I kind of viewed it. See, here's the thing: we don't know what it IPO'd at. I mean, it might have been fairly attractive. It might have IPO'd at like literally one half the valuation that S&P or SAP bought them for. But yeah, I think you can safely say SurveyMonkey is the closest competitor. They're not exactly identical companies though, and Qualtrics has a much stronger growth rate. SurveyMonkey, I believe, is roughly a low teens revenue grower. They're very consistent. They've had a nice steady growth trajectory over time. But I think Qualtrics does more. I think they do more. I think they've got a broader platform. I know for a fact SurveyMonkey does not have, or historically has not had 40% year-over-year sales growth. I'd have to go back and look at the notes on them, but I want to say it was like low to mid-teens growth over prior year. Now there was a thought, the whole bullish thought of SurveyMonkey was the IPO could give them more gravitas, it could give them more publicity, It could also give them more money, and then so they could be an accelerating growth story. And that's kind of the people, obviously, that were buying them at the 16, 17, 19 bucks, I think, definitely believe that their growth rate would accelerate. We'll have to see. I would say, chance of a pretty good report is probably pretty high. So there's no way I'd have no interest in selling SurveyMonkey here. I don't think I've got a huge risk of taking much of a hit. I'm roughly flat. I'm down a little bit. But, I'm not too worried about this. You know me, I can own stocks through 3, 4, 5, 12 earnings reports. So I almost need to see the report though. I don't, it's hard for me to formulate an advanced thesis on SurveyMonkey, because again, I didn't love the IPO, but I kind of liked it. It was, I have lots of companies I own right now with far better growth rates than they have and pretty attractive price to sales ratios. So, I kind of thought, hey, at 12, there might not be much more downside, and they kept going lower. But I think I'll get paid off. I mean, I would be surprised if we don't see the stock trade back. Again, I felt they were worth 14.5 to 16 bucks. So that's kind of where I think they'll head back to at a minimum. And by the way, if I felt like if I would have bought them at $14.50, I would have wanted some upside. So I've got a vision that they can trade higher than that. So we'll see. But yeah, no, I mean, it's a good question, because it might be a decent little spec trade with earnings coming out and the fact that a competitor got bought. But I will say this: they're not a 40% grower. They could become a 40% grower, but their metrics are not nearly as good as Qualtrics metrics.
Another listener has a question. This deal that SAP made, does it impact Cloudera and Hortonworks? Do they participate in that space as well?
I don't really think so. I mean, there's tons of, people, I think the mistake that some people make is they think, oh, hey, XYZ company just bought this other company, and, therefore, it's way more competition. Well, if you have to think about it, Qualtrics has been around for a while. So just like Cloudera was around for quite a few years before it was ever a public company, right? Splunk, I remember evaluating and trying to get companies to use Splunk 4 or 5 years before it was ever a publicly traded company, right? So the point is, Splunk was competing with Data and SAP and IBM and you name it for the whole time they've been in existence, right? Just like Qualtrics has been competing with everybody the whole time it's been in existence. So these software companies are competing with both the public and private companies that are out there all trying to grab business, right? So just because another company buys another company, or another company all of a sudden goes IPO, or a company gets taken over, that doesn't change the competitive landscape. It might to some people that don't know technology, I guess. But whether companies are public or private, it doesn't change their competitive view. One of the toughest competitors out there in the software space for decades has been a company called SAS. And SAS is probably one of the largest private companies in the world. They're a very, very strong software vendor. They've never gone public. They've always said they're not going to go public. They're going to stay private. Isn't Koch Industries a private company, right? The Koch brothers. So if you're in the same space as them, just because they're not a public company doesn't mean you don't have to compete with them, right? So what I would say is that, buyouts tend not to change the competitive landscape very much. If anything, sometimes they actually open up competition, because sometimes if the acquirer doesn't do a great job with the acquisition, it might almost harm the company they're buying, right? So in some cases, they turn a good company into a great company, and the acquiring company gives the acquired company a lot more ammo to go fight and compete and stuff like that. A lot of times, companies the ultimate example is something like Workday. Workday would probably not exist had Oracle never bought PeopleSoft. So, but Oracle did a hostile takeover of PeopleSoft, and what did the PeopleSoft guys do? They went out and founded Workday. I'm generalizing a little bit because there's a little more to it than that, but that is, some of the founders of PeopleSoft ended up becoming the founders of Workday. And so then what is Workday done? They've literally feasted on lost market share of Oracle and PeopleSoft pretty much the whole time they've been in existence. So that was a long-winded way of saying that no, these companies all compete with each other pretty much from their day one of existence. So typically getting bought out doesn't really change things much.
All right, and I think we'll end on this one. This being back, it's a follow-up to your IIVI, and that you mentioned that you made a trade in IIVI a few minutes before you got on, and they want to know if this will be an official call. I kind of know your answer to this. I bet you I know your answer to this question. However,
I'm not sure exactly what they mean. I mean, my official call would be that, I started building an IIVI position, 6 points higher, right? So maybe even higher than that. Anyway, but that 38 to 39 area is where I kind of sunk my teeth into it. It's 6 points lower now. It doesn't really dissuade me. Again, I didn't know light was going to guide down by 25 to 30% when I bought IIVI. Now, again, I do believe that's actually IIVI and Finisar's benefit. I don't think the market fully kind of grasps or understands that yet. So I'm not really sure about the call, but if they're saying might IIVI become a top 20 focus list stock for me, it probably will be. Well, especially since...
go ahead. I think what we have to do, and I wanted to give you an opportunity to do this, is lay out how you actually trade stocks, because I think what a lot of our listeners get mixed up on, and a lot of the people on that just subscribe to the Briefing Trader product, is that they don't necessarily differentiate your trades and your investments versus somebody like Blue Chip Trader or Event Trader who are shorter term. For instance, Blue Chip Trader will go out on a call, and he may take a day trade, but he's mostly looking for swing trades that will be something that may develop over the coming days, maybe a week or so. He'll take profits, and does a lot of momentum type trades in some of the faster moving names, high quality trading vehicles, versus yours that you will pick a particular stock that you're going to put in your investment portfolio. And I know that you did mention that this was a name that you're going to trade. You will do trades like that you will not necessarily post, but it's income for you. And I'm not sure that they differentiate what you're talking about in terms of that. So you may want to just give heads up to those
So here's the easiest way to say it. Put it this way. Right? I bought some in the 38s and I have no intention of selling it. So I'm not going to sell it until either I guess I'm dead and I have to sell it to pay for my funeral, or I make money on it. So I fully, I wouldn't have bought some at 38. Now, I had planned to buy more at 35, but that was before Light pre-announced. So as far as the $32 trade, I mean, it could end. I don't know how long I'm going to keep that. I know I'm going to keep the $38 trade around. And I know I'm going to build this position over time, and I will probably trade this a number of times. Yeah, but I think to answer, and Jim, you pretty much hit the nail on the head. I tend to post what I believe I'm going to keep, and I tend to post what I think is sticky and sustainable. I do a ton. I don't have time. I do a ton of trades that will never get posted. It's just the way it is. So the bottom line, though, is I think that this is a position I plan on building over time. I would say that for sort of my personal portfolio, I've got somewhere between like a quarter and a half of my total position right now in it. I do believe that, ultimately what would be nice, or what it was kind of a question that was answered or asked before. If Finisar got to where it was a good swap level, what I'd ideally like to do is just swap my Finisar into IIVI. And so then I wouldn't have two positions in that. To me, because it's the same company now. And I do think this deal is going to get done. Either if it doesn't get done, I'm not worried about China approval. That was like some idiots on CNBC were saying, well, the reason the deal's down is because it might not get China approval. I mean, that's just that's idiotic. The reason the deal's down is because the powers that be, the trading powers that be, it's easy to attack in the acquiring company right now. There's low liquidity. There's not a lot of institutional sponsorship. It's very easy to rate a stock that's the buyer, and therefore kind of try to push the deal price down, especially if there's debt involved, and there's debt involved in this deal. I'm willing to suffer through a little bit of short-term pain. But yeah, no, I mean, I plan on buying this again. I was going to buy some more at 35. I bought some more at low 32s instead. I might take the trade though. I think that's what we kind of talked about when the call first started. Like, hey, if this thing's at 33.20 by the close today, I might shuck it and just take the trade. And then I might put another trade on, but I will eventually increase my position in this at some point. And I'm a long ways from a full position, so we'll see. And hey, I've got the capacity. I could make IIVI roughly the same size as my Finisar trade if I wanted to. I don't know if I want to own that much in the fiber optic space in totality, but I could. I mean, it would to me. I don't mind overweighting in a group. If I feel really strongly about the one thing I will say about 3D sensing, and I know some people might find this shocking, but this is I basically know this is going to be one of the strongest growth areas in tech for a number of years. And I've said this before, that 3D sensing should be one of the very strongest areas in tech, especially among a lot of other areas of tech that have declining growth going forward. So I really do believe this is a market share shift. I don't think this is an Apple iPhone issue. I don't think this is a 3D sensing growth issue. By the way, we've seen this before. I mean, I remember a company called Portal Player, which I believe had an audio socket in the iPhone, dropping, I think, 65% in one day. By the way, Portal Player, I think, got bought by NVIDIA. That's a whole nother story. But Portal Player dropped, and I think some people kind of tried to make it out to be a kind of an iPhone issue. It wasn't. They literally lost their socket. Might have been to Cirrus Logic, actually. But anyway, there's been, this used to happen more often, by the way. There used to be more volatility in the Apple supply chain, meaning Apple would actually, there were more suppliers that would vie for the business, and then they would win sockets, they'd lose sockets. There was more shifting back and forth. The Apple supply chain has been pretty steady for quite a few years now. I'm trying to remember the last big win. Was probably between RF Micro and Skyworks a few years ago, and then guess what happened? Skyworks ended up buying RF Micro devices. But there just haven't been a lot of big, like you haven't had an audio socket loss by Cirrus in a long time. You know, you haven't had a major, I'm trying to think, the last major, another loss that was a big loss at the time, and I can't remember the company that was the loser, but Apple bought a company called PA Semi, and PA Semi was a private company, so that's when Apple started doing their internal chip development. And that was, I can't remember who that was, but that was a big loss for somebody, because at one point, somebody had all the market share for the core chips that powered the iPhones. Might have been Samsung, by the way, but I think it was somebody else. Anyway, long story short, we don't see a lot of volatility where companies lose sockets now, and then they have these huge drops or these huge market share shifts. I mean, this I think this is one of those cases. But yeah, anyway, long story short, you know, I'm much more interested in IIVI. I mean, basically, to me, if I'm buying IIVI now, I'm basically buying Finisar. You know, I thought Finisar was really cheap. I thought it had a lot of upside. I still think the assets of Finisar have a ton of growth and a lot of upside. Unfortunately, Finisar is not going to benefit from them because they chose to sell out for, I really think they made a mistake. But they might not have had a choice. I mean, they just might not have had a choice. They might have lost the business. And had Finisar completely lost that Apple contract, the stock was probably a single-digit stock. And so maybe they don't want to kind of suffer through that and have to rework their way out of that again. So, you know, we'll see. We'll see what happens over time. But simply put, I'm not, you know, stocks are going to move a lot. They're going to trade a lot. IIVI is down. I mean, I think the most surprising thing, I'll end on this. Why is IIVI down half of what Light's down today? So, I mean, if you just kind of know about Apple, know about the food chain, and kind of look at the numbers, well, it's down because a lot of people are selling it today. And the algos are putting pressure on it, and there's obviously sell programs against it or shorting programs against it. But obviously, some people that own IIVI don't have the faith in their conviction. And they're choosing to let the stock get taken out from them at a very attractive price because of fear, right? So, they either don't have the belief in what they have done, the research they've done before, or they're more trend traders, or they're more willing to kind of trade price. But if you kind of know this food chain, it's I don't know. I'd rather be a buyer of IIVI here. And my opinion is not going to change as the stock goes down another 4 points. By the way, I'm not a complete. I have very good chart tools too. There was a $28 figure on this thing. They had a really, really nice spike low between 27 and 28. I hope it goes there. I mean, I wouldn't mind if it goes to 22. I mean, in fact, the last great buy on IIVI, part of the reason I wasn't an IIVI buyer on its own at 42, 44, 48 bucks is because I remember when this was an $18 to a $22 stock. So the last truly great buy in the stock was you had two great buys in 2016 where this thing traded crazily cheap, kind of low teens and high teens. I don't think it'll go that low, but hey, I've seen stranger things happen, and when you have that bar, you have that candle down there at 27, 28 bucks, they might try to shoot for that because hey, can they can sell it down there as long as there's willing sellers of the stock. And so, I tend to have a lot more conviction than a lot of other people. So, if it goes to 28 bucks, I'll just end up with more of the company than I originally planned. And then when it goes back, I mean, I do believe that this could be a much more valuable company than would they have been had they never bought Finisar. I mean, it truly is amazing to me that they were able to buy Finisar for the price they did, and yet that has not benefited them all. It's just made the stock price go down. So, I mean, just put that in your logic. I mean, you know this for a fact, Jim, that the one thing stock prices aren't is logical. They're very, they're very illogical.
It's all contingent on the sentiment of the day, and that could change in pretty much on a moment's notice. But all right, I know I said that was the last one, but I'm going to allow one more question from our listeners.
Hey, you know what? We can stay. We can stay on as long as you need. I'll just say that right now.
Yeah, I know, but at some point I got to cut it off. But I got one more. I can't stay here all day. So this last one I'm gonna allow because I don't recognize the email from this particular listener, and most likely they probably haven't asked a question before, so I want to make sure they're able to get some questions in. And I know it's a stock you talk about a lot, but it is trading at a pretty low point, and that's MTSI. What say you on this one?
I've said a ton on this. I mean, so sometimes there's just not a whole lot new to say. This thing's just kind of been trading kind of, I don't know, they had a good report. I would say their last two reports were good. It's traded quite a bit higher. I mean, 10 points higher, huge percentage higher just a few months ago, even a few weeks ago. This is kind of part of this, this risk-off trade. If you basically just pull up a chart, you can almost to the day, what is this, August 9th. So you can either look at August 9th, late August, September 1st, but October 1st, whatever, pick a day, but you can almost just say, like, look, since their last high, last notable high, you've pretty much been risk off since then. And sometimes a stock will just trade bad because on a net basis, there's just way more sellers of it than buyers. I know that might sound like a kind of almost a cop-out answer, but you really, if you're going to trade stocks in today's environment, you have to be aware that the average stock now spends more time going down than going up. And so, especially if it's not part of ETFs, and especially if it's not part of mutual funds, especially if it doesn't have institutional sponsorship. So whenever you're dealing with mid and small cap companies, it's just way easier to raid them lower than to raid them higher. And the other issue with MTSI is that this was a big, glorious sort of cult winner. I mean, this was a $60 stock not that long ago. As a stock, I actually said was a good short. I didn't personally short this, but around the time I called out AAOI, and Jim remembers this as a short, in sort of the 85 to 95 range, I basically said MTSI was pretty much similar. And it was basically peak earnings. So they had peak earnings, peak fundamentals. And once they missed that first report, they basically lost institutional sponsorship. So the stock has gone from being a cult favorite to a cult hater. But I buy value, and I've bought this stock anywhere from 15 to 20, and I think it has a lot of value. But there's not really much new to say. The other thing that I think does hit them, they're known as a company that does a lot of business in China. Even though the percentage of the business is not, I wouldn't call it massive. I've talked about this a lot. There's a company called Neon Photonics, which I've done pretty well in. And they're down quite a bit today, but I mean, they've traded very well. There's no company that I know of that does more net business in China than they do. What's really interesting, there's been all these China trade fears, trade rumors, and everything's bad, and Chinese are going to kill us and not buy any fiber optics from us, and blah, blah, blah. Well, the company that does, I mean, they literally do like 60 to 70% of sales into China. It's far, far more than any other fiber optic supplier by magnitudes. I think they do 3x more business in China than the next closest company that does the most business in China. And yet they've traded pretty well. So if the China trade fears were really going to kill this industry, I would think that Neon Photonics would have been cut in half by now. So it's the fact that Neon Photonics has traded sort of the best of all the fiber optic names is pretty interesting. When in fact they have the most Chinese exposure in the group. So companies have their own cycles, their own trades. Probably the strangest thing to me, though, is given that the last 2 quarters are relatively good for MTSI. In fact, I think I called trough quarter on them 2 quarters ago, and so far that call's been right fundamentally. If they're retesting lows, they're going to a lower year low. But we've been risk off. I mean, we've been risk off for a big part of this year. We've been risk off certainly since September 1st, maybe even a little before then. This is a stock that unfortunately is just probably not going to trade very well as long as we stay risk off. So the good news is risk off is that you don't stay risk off forever. At some point, risk off ends, and you either go to kind of risk neutral or risk on. This is a name that under risk on, you get a China deal or you get risk on, or they finally have sometimes it takes the 3rd good quarter, sometimes even the 4th good quarter. I remember I held Hortonworks for a number of quarters. It was either their 3rd or 4th good quarter, and that stock would not get back above 10. That was a stock that broke down from 20, went to 6 to 7, popped good quarter, and the thing wouldn't go much above 950.10. And then all of a sudden, it goes from like 850 to 22. And it was either the 3rd or 4th good quarter. And all of a sudden, the stock took off. And Twitter kind of did the same thing. They held Twitter down for quarter after quarter after quarter. Now, a few of those quarters were bad. But the same thing, it was at least the 3rd, if not 4th good quarter before that stock finally took off. And when it finally took off, it finally tripled off of lows. So MTSI will probably do the same thing. By the way, I mean, Micron, same deal. Now, they popped pretty good. They went from 10 to 15, 16 when they finally bottomed and put in a couple good quarters. But same deal. I mean, Micron had a hard time really staying above 1450. Same thing. It was either 3rd or 4th, maybe even 5th good quarter. And then finally, what'd they do? In fact, I thought they were going to top out around 40, 45. They went 65. So, MTSI will probably trade a lot like any of those names. Once it finally gets through and there's institutional sponsorship, or there's risk on, or there's finally just too many good quarters in a row, and then all of a sudden the stock becomes a buy and not a sell again. So I've written a ton. I mean, anybody has questions on MTSI, they're just kind of honestly not, no insult to the person asking the question, just type MTSI into the search box. I've written a ton on it. So there's not really anything I can verbally say that I haven't written already on it.
Yeah, and I'm not so sure this wasn't a new listener, because I didn't.
Oh no, but even if you're a new listener, type in the ticker into that search box, and there'll be a ton of commentary there.
And it could be the fact that the stock's down about 7% or so today, and if maybe you'd be interested in buying. Any idea what the short interest is in this one?
I don't know. Yeah, that's something. In certain stocks I pay attention to short interest. Others I really don't. I probably paid more attention to short interest if I think it's maybe a catalyst. I don't know if it's high enough on this name. So, but yeah, I mean, it's just like I say, I wouldn't be surprised if they ever. I mean, how did Acacia report? They reported, and we haven't seen. I think we've only seen like 2 or 3 of the fiber optic stocks so far this quarter. In fact, I mean, IIVI is really more of a 3D sensing laser name. It's not a traditional fiber optics company, although people kind of put it into that camp. But if you include them, I think we've only seen reports from Neon Photonics, which did report pretty well. It wasn't a great report. It was just okay. IIVI had a clean beat and raise, and Acacia had a clean beat and raise. And, you know, I've long said that Acacia is one of my favorite names, period, especially from lows, from those $30 lows, not the spike low, but the kind of that 32, 34 range. So, you know, MTSI is just part of the group. The group's is having a hard time. This is a tough group. Again, I remember, again, not to talk too much market history and be too long-winded, this group did very, very well. But there was a short-term issue in early 2011. So again, Finisar had gone from 2 to 45. Sienna had probably gone from 4 to 28. This was from the bottom in 09, 08, all the way to January, or the spring of 2011. Then we had the debt crisis, the second phase of the debt crisis in 2011, U.S. debt debate, European debt issues. And the fiber optic group had a really rough kind of 2-quarter period, and that was about it. I mean, they had 2 really bad quarters, and then they kind of kept reporting kind of okay again. But this group didn't come out of its own bear market from like the middle of 11 until sort of the middle of 2013. And again, it wasn't like the group had a tough 2012 fundamentally. It's just that the reports weren't great. They were just kind of okay. But some of these stocks actually were cheaper in 2012 than they were in 2009. And so it's just, you know, it's a lot of small mid-cap stocks in this group. Therefore, you know, they're not part of ETFs. They're not part of the program buying, and they're, you know, they trade tougher. You know, but they also have a lot more upside when they finally get cooking. So, I mean, the one thing I'd say is, hey, I'm just glad I avoided light. I mean, what did most people do in this group? They would say, oh, that stock trades bad. Oh, I don't know if I like it. I'm just going to stay in light. Right? That was the typical trade. No, I'm just going to stay in light. I don't like any of the others. Oh, the others are junky, blah, blah, blah. But look at light. Look how great light is. Well, you know, if you stayed in light, you ended up taking an awful lot of pain, because if you had stop orders, they didn't protect you much. I think pre-market the thing was lower than it is right now, actually. So the bottom line is, you know, if you're trying to hide out in the one good chart, that's pretty much almost a guarantee that you're just gonna wait to take your time at the whip. I prefer to look at things holistically and look at the fundamentals, and that you know, Acacia's had good quarters for a number of quarters now. MTSI's had good quarters for a number of quarters now. I mean, I'll end on this. I'm going to be, you know, so you mentioned I probably wasn't real happy with the Finisar deal. What's going to make me a lot less happy, I kind of almost had a feeling that they might report the best in the group this quarter. Just a lot of the way their products line up, the way the 3D sensing portfolios line up, the way the manufacturing, I think their Sherman facility is done. It's full capacity now. I won't be surprised if Finisar basically produces a whopper of a good quarter. and yet they sold for what they sold for. So, but we'll see what happens. But I don't think Finisar's reported. I think they're going to have a really good quarter. MTSI has yet to report. The one stinker in the group is INFN. But even there, even their report, I don't think relative to where the stock price is. I mean, this is a crazy stock price. I mean, in an old uptick rule world, the stock just wouldn't go down much below $5.50, $6. I mean, you have mountains of bad news priced in that stock. And yet, we don't have an uptick rule. So a stock can already be at crazy low prices and still drop 25 or 30%. And that's what INFN did. So, but yeah, I mean, we'll see what happens. MTSI, like I say, just do a search. I've written a ton about it. And so, we'll see what happens. But I don't have too much worries on this group long term.
All right, and just for the record, Finisar does not report until December 6th. So.
Yeah, I was going to say they're still a ways away, but like I say, that's really going to irk me because I almost kind of have a very good feeling of how they're going to report, and I wouldn't be surprised if it's like literally one of the best reports in the fiber optic group. So you just have to kind of say, okay, well, wait, how'd that happen? Well, what would have Finisar traded to just on an earnings beat, right? So if they have a good earnings beat and a good guide, would the stock have gone north of 22 on its own? I think that probably would have. But again, I really do kind of think that I think what basically happened, long story short, is Apple pretty much said, hey, you guys need to seek a partner. We want somebody that's going to help you make sure that you manufacture all our parts to the exacting precision that we require, we being Apple. And, this has happened before. I think a lot of these semiconductor companies, the largest Apple suppliers, have probably done a lot of M&A at the behest of Apple. Like Apple wanting, hey, we want you to have more capability, more manufacturing capability, more R&D capabilities, et cetera, et cetera. So I think Apple has sort of steered and driven a lot of these chip companies that may not have done M&A to do M&A. And yeah, I think this is what happened. I think, unfortunately for Finisar, I think they got they made a deal with the Gorilla, and the Gorilla basically once you get in, you're doing business with them, you pretty much have to do what they want to do, or you're going to lose the business. And we'll see what happens. I mean, ultimately, again, should be a good thing. I mean, if you're IIVI, you got to be dancing in the aisles of the company, because I think they not only are doing well on their own, but this almost could be. I wrote years ago that Elpida, the Micron buy of Elpida, literally was a game changer for the DRAM space, and pretty much ever since that buy, ever since Micron bought Elpida and took a lot of excess capacity out of the group, that whole industry has traded better. DRAM, SRAM. The memory chip space has traded a lot better since that Elpida buy. And that put a lot of power, a lot of manufacturing, and a lot of pricing power in Micron's hands. And this could kind of end up looking similar. It really could. Long term, by the way, Light is very well positioned because they just bought a Claro, or they're going to. You're basically going to have a 3D sensing oligopoly now. So because aside from the combined entity of IIVI and Finisar and Light, I mean, you do have some other smaller players out there, but now it's going to be the big two. You're going to have two companies basically that. I think globally are going to have like 85 to 90% share of 3D sensing, and it's probably going to be good for both companies ultimately. I gotta see Light. I gotta give Light room though. I think that this is gonna be in the penalty box for a while. But no, I mean, 3D sensing is going to be a great growth area, and it's going to be dominated largely by two companies. So long term should be a very, very good deal for the space.
All right. Well, I don't know what the earnings outlook is like for the rest of the week right offhand, but should we get some more of your favorite names out this week, then I'm sure we can get you on, and we'll do some follow-up on all this
Well,
stuff.
MTSI reports tomorrow. By the way, somebody said SurveyMonkey was tonight. I thought SurveyMonkey was Tuesday. Pretty sure SurveyMonkey is Tuesday. And by the way, we did have a cloud deal. Not to keep this going too long, but Aptiva, is the name I had just started doing some work on. Aptio, maybe, yeah, Aptio, APTI. This company is getting taken private now. There you go. That's pretty good premium. I think they're going to go off at about 7.5 times sales. So it wasn't just that company that SAP bought. The Aptio is getting taken private. So people are still snapping up these high growth cloud software names. And again, is it benefiting the trading of anybody else? No. So that's another sign. It just shows you how sort of risk off we are right now. Because if we were in risk neutral, some of these cloud buys we've seen, whether it's Red Hat or Quadrix or Aptio, or then there was another one too. You would think that would actually have some positive pin action, but they haven't. So again, we've been very risk off since for sure September 1st.
All right, and just for the record, SurveyMonkey, we have it tomorrow after the market closes.
Yeah, I was going to say I didn't think that was tonight, so that's good.
All right. Well, with that said, why don't we check out from here, and we'll see how these earnings shape up. We do have a handful of ones that you cover pretty extensively, so why don't we touch base later on this week?
Sounds good. Have a good one.
Hey, you too, Sean. Thank you, as always.
All right, take care.
All right. All right, so that was tech trader Sean Udell. Had a lot of information for us on a lot of different stocks, a lot of ones that we've talked about, but I know a lot of the listeners like the updates from him, especially when we get big stock moves in like the likes of MTSI that was down 7%. So I don't mind asking the questions. So when he is on, feel free to hit us up. I try to get as many in as I possibly can. I can't get them all, but I do my best to try to serve you guys out there, because I know it's the interaction that you guys are able to get most directly to him, and it's more immediate than waiting for an email answer, although he is pretty good about answering the emails as well. So as always, feel free to hit him up or any of us up on the Talk to Us button, and usually we'll be happy to respond and give some color, especially if it's a question regarding a particular take or whatever on a specific name that any of our traders are involved in.